Platinum is a truly fascinating commodity. It's known for its rarity, which is why the precious metal is a staple in fine jewelry. Yet, its remarkable physical properties make it indispensable in industrial applications ranging from the automotive industry to the production of hydrogen. So, what are the cyclical and structural forces shaping platinum's future? Where are we today? So, we are very excited to explore all of this and much more with Edward Sterck, Director of Research at the World Platinum Investment Council and a returning guest on our show. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen Tahir, Director of Macroeconomics and Thematic Research at Wisdom Tree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at Wisdom Tree too.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and in this episode, the World Platinum Investment Council, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. With that, Nitesh, let's kick things off.
So Ed, thank you so much for joining us once again.
Well, thank you very much for inviting me on. It's a pleasure.
Great. So we see you've published your Platinum Quarterly, your Q3 2024 piece earlier this week. Makes an interesting read. Summarize for us, what is the projected platinum deficit for 2024 and your expectations for 2025? And what are the main factors that are contributing to these deficits?
Yeah, it's a good question, Nitesh. And I think that probably the key takeaway from the quarterly would be that what we're seeing is a real continuation of themes that have been emerging over the last 18 months or so and look set to continue really into the future. So the two themes are principally constrained supply. So mine supply is really struggling to meet demand for platinum. And then ongoing sustained robustness of demand, I'd say. I mean, we're not looking at a market where we're seeing significant demand growth. We've got 2% year-on-year demand growth projected for the automotive and separately for the jewellery industries next year. But it's not staggering rates of growth. It's just really that supply is inadequate. And the question is, well, why is supply not enough to meet demand? There's two things. On the mining side, you've seen a significant decline in the prices of palladium and rhodium over the last few years. And all of these platinum group metals, including palladium and rhodium, are produced from the same ore bodies. So the economics of those mines are dependent not just upon the price of platinum, but upon other metals, including, as I said, palladium and rhodium, but then also gold, the minor PGMs, base metals, nickel, copper, and chrome. And so for the mining companies at the moment, the economic incentive to increase output just isn't there. And then on the recycling supply side, so roughly 25% of supply is related to recycling, mainly of end-of-life vehicles and spent catalytic converters. We're just not seeing the end-of-life vehicles come through the system at the moment. So people are either not scrapping their vehicles, or when they do scrap them, the catalytic converters are not being recovered from those and fed to the recyclers. So recycling supply is down by about 600,000 ounces a year from its highs, which is quite a significant drop. Total demand this year is about 8 million ounces, to give you some context to that. And we are expecting a bit of recovery in recycling supply next year, up around 12% year on year. But there are certainly risks to that outlook. And if you talk to the recycling companies right now, they're continuing to tell us, actually, although base case assumptions, it's sensible to assume that we will see a recovery in those recycling rates. They're just not seeing it come through in terms of the raw materials. So, just to kind of summarize, it's that constrained supply landscape that we're looking at, and ongoing robustness in demand that's driving those deficits.
Excellent. So, I mean, just looking at your demand side of the equation, we saw that the projections for 2024 for automotive demand to actually slip a little bit, but for 2025, you're expecting an increase. Tell us a little bit about what's driving that increase in automotive demand.
So if we look at the vehicle production numbers, we're kind of expecting about 79 million light-duty vehicles for this year. And then what's baked into our numbers for next year is 78 million light-duty vehicles that contain an internal combustion engine. Battery electric vehicles are on top of those figures. So 1 million fewer vehicles next year in terms of light-duty vehicles. We are expecting a bit of an increase in heavy-duty vehicles next year, which is part of the reason we see that modest increase in automotive demand, 2% increase year on year. But the other factors are increased hybridization. So hybrid vehicles typically have 10 to 15% higher loadings than the pure ICE equivalent. So although we've got 1 million fewer internal combustion engine vehicles, more of those vehicles are hybridized, so have higher PGM demand as a result. And then also we've got increasing substitution of platinum for palladium in gasoline vehicles. So essentially, in catalytic converters, you can use a mix of the different PGMs. You can either use more platinum or more palladium, and vice versa. And the ongoing trend at the moment is that platinum is being used in preference to palladium because of the high price of palladium over the last few years. That has come down closer to where platinum is today, but for the automakers, that trend is just continuing. The other thing to bear in mind from a sort of ratio between platinum and palladium point of view is that there's a lot of geopolitical overlay to this. So in terms of global mine supply, around 70% of platinum comes from South Africa and 11% of platinum comes from Russia. In terms of palladium, it's 45% from South Africa and 45% from Russia. So for an automaker, the more palladium you're putting into your catalytic converter, naturally, just in terms of market balance, the greater your exposure to Russian supply risk becomes. So for the automakers, even when you take out of the equation the price of the metals and therefore economics, there's an incentive to continue to maximize their platinum exposure and minimize their palladium exposure in order to try and mitigate that Russian supply chain risk.
If we explore that point about automotive demand a little bit further, I was just reading this morning in the FT, the UK is actually contemplating allowing the sale of new hybrids for a lot longer, into the 2030s. This is a news that shows that hybrids might be around for even longer. In the US, we know President Trump is back in power. Maybe that affects how the automotive industry evolves in that part of the world. Do you see a shift in how you see the evolution of internal combustion engines, hybrids, and electric vehicles in light of these emerging trends and what governments are doing around the world, and how that might impact demand for platinum going forward?
Yeah, very much so. I mean, I'm a little bit cautious to kind of get too excited about internal combustion engines. Ultimately, we still do need to decarbonize the world. But the government actions that we're seeing, less so in the US, we can come back to that. But what we're seeing in the UK and Europe is very much consumer-led. The regulators, effectively in different geographies around the world, push the automakers towards trying to maximise their battery electric vehicle market share in order to try and reduce their fleet-wide CO2 emissions. And there's certain thresholds they're supposed to meet. So, for example, from July next year, European automakers are supposed to cut their fleet-wide CO2 emissions by, I think it's 15 or 20%. The way that they can achieve that is by maximising their battery electric vehicle sales. The problem is consumers just don't want to buy them. So there's this ongoing reluctance from the consumer to adopt full battery electrification. And that's because of expense. They're on average 13,000 euros more expensive than the pure ICE equivalent. It's due to, frankly, a number of other factors associated with range anxiety and a lack of charging infrastructure. And so the way to kind of think about it is the early adopters of battery electrification have adopted, and they did that with government incentives and subsidies and tax breaks and so on. And those have been unwound. And the principle behind that is very simple. The governments have said, well, we'll incentivize the early sales of these vehicles, and then as production increases, costs will come down due to economies of scale. We can wind back our support, which is the way things have played out. But that's not enough for consumers because of these other concerns. And so for the governments and the regulators, they're being pushed by the automakers now, who are facing some really significant fines if they don't hit these CO2 reduction targets. the automakers are saying, well, this is great, but unfortunately, our customers just don't want to buy these vehicles. So we're stuck. What are we going to do? And you're seeing that kind of reaction come through in the UK, for example, as you mentioned, maybe in terms of allowing more hybrids for longer and things like that. There really isn't a choice. You can't force people to buy a battery electric vehicle, unless you completely ban internal combustion engine vehicles, and there's a whole load of challenges associated with that. I think the interesting thing is really when you look at the US and the election of Donald Trump, that could open up a whole different avenue of different scenarios that you might want to explore in a minute. But overall, the kind of trend is higher for longer ICE vehicle production, whether it's hybrids or pure internal combustion engine vehicles, and that just translates into higher for longer automotive demand for platinum.
We know that battery powered vehicles don't necessarily require platinum, but one type of electric vehicle, if it's powered by hydrogen, we know that platinum has a role to play. Increasingly, we've been seeing, particularly in some segments of transportation, like buses. Certainly, in the UK, I'm seeing more bus companies advertise that they're introducing hydrogen powered buses. I'm curious, what's your take on the role of platinum and how you see that evolving in these sorts of segments where we may see more hydrogen powered modes of transportation?
Well, I think it really is the future in many regards for platinum demand, probably dominated, as you point out, by sort of heavier duty vehicles, so buses and articulated lorries and things like that. So it's really well suited to roles where you've got a high capacity utilization rate. You've got weight considerations. So, for example, if you electrify an articulated lorry, you're giving up typically 20 to 25% of your load capacity to the weight of those batteries, and then you've got a long recharge time and things like that. So, hydrogen fuel cell electric vehicles, you can refuel in about the same amount of time it takes to refuel diesel vehicles today. You just plug in the hose, fill it up with hydrogen, off you go. So you can maintain really high, as I said, capacity utilization rates, and you don't have the same weight penalty that you do with batteries. The problem is at the moment that we've kind of got to put the horse in front of the cart. You need that hydrogen infrastructure, and you need the economies of scale in terms of hydrogen production to bring down the cost of that green hydrogen, to then get the consumer to adopt these vehicles as an alternative to battery electrification. Now, for bus companies, that makes sense because you're typically you can put your hydrogen refueling infrastructure at your terminals, at your bus nodes, and you just refuel the bus when it gets there. But we're not really seeing that spread to petrol stations around the kind of country and around the greater region. So you need that in place really for then the kind of private companies that to adopt these vehicles. It will happen. It'll happen in time, and we're seeing the subsidies flowing from governments now. So, for example, this year alone, we've seen a quintupling of electrolyzer capacity from 1 to 5 gigawatts, and that's a significant increase. So we're really on kind of the bottom end of the hockey stick in terms of the curve, and that will eventually translate into broader infrastructure in terms of supplying hydrogen to the markets at a reasonable cost. And then I think we'll see broad scale adoption of this technology. But we're kind of talking to sort of later in this decade and really into the 2030s before it begins to flow through into a meaningful impact in terms of platinum demand. And to give you some context for that, as I said, total demand at the moment is about 8 million ounces. Hydrogen demand for platinum this year in our numbers is about 100,000 ounces. So, it's small, but it is growing quickly.
It's great. You mentioned Trump earlier on and trying to link Trump with hydrogen. The Inflation Reduction Act, a piece of legislation under Biden, poorly named because it doesn't do anything to reduce inflation. But will that IRA get support under the Trump administration? And if it doesn't, what would that mean for support for the hydrogen economy? I don't know if you have any thoughts on that.
Well, I mean, I think I'd start with a caveat, which is to say, well, who knows what's going to happen?
Yep.
It's Donald Trump after all. But he has said he doesn't like the Inflation Reduction Act. And so there's a reasonably good chance, especially as he has control of Congress, that he will try to rescind that act. That's the main mechanism. The Inflation Reduction Act is the main mechanism for government support for green energy, including hydrogen, in the United States. So it is quite important. The reality is that actually, if you look at the way that support is structured, in dollar terms, in theory, it's the biggest around the world. If you look at the way that it's structured at an individual project level, it's really not as accommodating as the support that's provided in Europe or in China, for example. So on our future forecasts, the US is kind of important for hydrogen demand for platinum, but it's a distant third fiddle to China and Europe. So whatever happens in the US doesn't really change things that much. That said, and sticking on the Trump theme, if he does rescind it, I think there's a reasonable chance he'll replace it with something that's not too dissimilar. And the reason for that is actually the states that are the biggest beneficiaries of the Inflation Reduction Act funding are predominantly Republican states. So he can get rid of it because obviously he said it's rubbish, so it's got to go. But there's a reasonable chance that he will replace it with something that's similar, but much bigly better in Trump terminology. But basically that's broadly the same sort of thing. I think the interesting thing in terms of him coming in is also in terms of the automotive industry and the landscape there. He's obviously pro-oil. There's a lot of support in the US for ongoing electrification of the drivetrain right now, which he may kind of rescind. But his biggest supporter is Elon Musk, who owns Tesla. So, the way I'd see this playing out is potentially that Tesla's got a first mover advantage versus the established Detroit automakers. So, it doesn't necessarily need huge amounts of support. People will continue to buy Teslas. But if he removes the kind of support for electric vehicles sort of on a broader scale, then the Detroit automakers will kind of revert to building, gasoline vehicles and all that sort of stuff. And he's sort of giving, which is positive platinum demand. And he just leaves Tesla with that sort of embedded market advantage that it will continue to grow from, probably.
Wow, that's a strong move. I mean, especially if it puts tariffs on Chinese vehicles even higher. I mean, not that the US imports a lot of Chinese vehicles, but that could keep the market more, sequestered for Elon Musk.
Yeah, absolutely. Yeah. I mean, but to give you some one sort of soundbite on this, the Chinese battery electric, the US is actually, it's not that important a market anymore from an automotive perspective. If you look at the Chinese market, the battery electric vehicle market in China alone is bigger than the whole of the US auto market today.
Yeah, it is amazing that China can just focus on its internal market and still have clear dominance there. But keeping on the sort of Trump theme, one of the promises that Trump made on his campaign trail was to end the Russia-Ukraine war in a day. I think we can all have our opinions of whether how easily that is achievable, but given how important Russia is for the Platinum Group supply chain, what implications do you think a ending of that war would have on supply?
In all honesty, I don't think it would make a tremendous difference. The Russian origin PGMs are still finding their way to market through China and anecdotally through the Middle East. The reality is that there isn't enough production of PGMs ex-Russia for the global auto industry, as an example, to continue to produce vehicles and for them to meet legislation. People are still having to buy Russian origin PGMs and just close their eyes and hold their nose and pretend that they haven't. So I think an ending to the war in Ukraine, might ease sanctions a bit. Maybe that takes a little bit of the supply risk out of Russia. I think the biggest challenge for Russian origin PGMs at the moment is kind of infrastructure based. So if you look at the impact of sanctions on them, they don't have access to Western origin mining equipment anymore. Now, in terms of things like drill rigs and scoop trams and so on, you can pivot to China and get Chinese alternatives. But your processing infrastructure in terms of plants, like your big ball mills, your flotation cells, those have all come from Western OEMs that they no longer have access to. As that infrastructure begins to fail because of the sanctions being sustained, there's a kind of risk of a gradual erosion of Russian output to those PGMs. maybe you take, with the end of the Ukraine war, if the sanctions are unwound immediately, which I think is unlikely, I think they'll be sustained for longer, just to kind of keep the foot on Russia's neck, as it were, then I think we could see a gradual erosion of Russian output due to effectively attrition in terms of plant availability. But I don't think it really materially changes or suddenly improves the availability of PGM supply to the market.
Something, Edward, we noticed in your latest report was how jewelry demand was up in the last year or so, even though some of the other segments were down in terms of overall platinum demand. I'm curious to just get your take on how significant this segment is to the overall outlook for platinum going forward.
So jewellery is about 25% of total demand. It used to be substantially more. So we've gone from around 3 million ounces a year of jewellery demand in 2014 down to about 2 million ounces a year today. That decline is entirely linked to China. So Chinese demand has gone from 2 million ounces down to 400,000 ounces over that time period. So 1.6 million ounce decline. And it's been compensated for to a degree by roughly 4% CAGR in jewellery demand growth from the rest of the world. I think the reason behind the 1.6 million ounce decline from China is largely linked to the ability to manage price risk. So in China, when you're, as a fabricator and retailer of jewellery, if you can't manage your price risk because there's no derivatives market for platinum in China, you have to put a big premium on the selling price and then a big discount on the buyback. And a lot of jewellery purchases in Asia, particularly in China, are funded through selling old jewellery back to whoever you're buying the new jewellery from. And so that bid-offer spread, if you like, in terms of the premium and the discount, doesn't really matter to consumers when prices are going up. When prices are coming down, it really erodes the consumer trust in that market. And particularly in contrast to gold, where there is a futures market, there is the ability to manage price risk, and so your bid-offer premium is smaller. I think that kind of erosion of consumer trust is behind that 1.6 million ounce decline in demand in China over the last 10, 11 years. The interesting thing is that we're now seeing a modest growth there. We're seeing growth in the rest of the world, particularly from India, in fact. That's suggesting that maybe we've reached the bottom in terms of the jewelry market and we might see kind of growth going forwards. And I think for China in particular, the Guangzhou Futures Exchange is planning on launching physically settled platinum and palladium futures probably early in the new year, which introduces the ability to manage price risk in China. Potentially that would allow fabricators and retailers to reduce that bid-offer spread or premium and discount on jewellery and gradually rebuild some of that consumer trust in platinum and therefore recapture some of that lost 1.6 million ounces of jewellery demand in China. That's an upside potential. I wouldn't bake that into anyone's base case forecast, but it's just an interesting thing. And that market, in terms of the futures market, is also going to be available to private investors and speculators, which could be interesting in and of itself. I do think that India is quite a key market going forward for jewellery as well, though. 38% year-on-year growth this year. The success in India is very much driven by our sister organisation, the Platinum Guild International, who's run very successful marketing campaigns there, including sponsoring Indian cricketers to wear platinum jewellery. And obviously cricket's quite a popular sport in India, and that seems to have captured the public imagination to a degree and helped drive demand there.
Very interesting also very interesting that you mentioned gold, because from an investor's perspective, we know that investors like to establish connections between different commodities. Like the relationship between gold and silver is discussed very regularly when we speak with our clients. Do you think most of the things that are driving platinum are quite idiosyncratic in the sense that we've discussed automotive industry, hydrogen, we've discussed mining coming from different regions, mining supply and so forth? Do you think the drivers driving platinum are quite idiosyncratic, or is there a relationship between, say, platinum and gold, or indeed any other precious metal that is worth keeping an eye on?
I think this is almost an entire conversation in itself, really. So there is, historically, platinum has traded on average at twice the price of gold, and it's currently trading at less than half the price of gold. And there's certainly people who look at that and go, well, platinum should react and recapture some of that lost ground versus gold. I'm personally not a huge believer in ratios and things like that. But what I can say is that the price of gold is beginning to price consumers out of the gold jewelry market, and they're looking for alternatives, which would include platinum. And certainly for the fabricators and retailers, their working capital requirements have just expanded massively over the last 12 months with a huge increase in the gold price. And so for them, moving and pivoting some of their inventory into other metals, including platinum, helps them release working capital. And that's obviously positive for platinum demand. At the same time, the biggest kind of question that we get really is where you've got these ongoing deficits for platinum, but the price hasn't responded. So that suggests to me that something is wrong in the market. Your estimates are wrong, what have you. So to react to this, we built a multivariable regression price model that looks at various inputs that go into establishing platinum market value, or in the past have gone into setting platinum market value, and essentially tried to get an understanding as to why platinum has not reacted to the deficits in the last couple of years. And effectively what the model tells us is that underlying fundamentals, in principal demand, were the biggest drivers of platinum market value up until about 2011. So through that China-driven commodity supercycle. Since then, what we call market economics as a kind of blanket term, which are things like Rand US dollar exchange rate, interest rates, the gold price, and also sentiment, which is really futures positioning, have actually had a bigger impact on platinum price than those fundamentals. But what the model informs us, and this is purely a mathematical construct, is that we're seeing those fundamentals come back to the fore as being the bigger driver of platinum market value over the course of the last couple of years. And if you roll the model forward and put in some inputs, they become increasingly important going forwards. And of course, then you've got things like the high gold price, which is helpful. Interest rates are coming down a bit, which is helpful. They may not go as low as we were expecting them to go because of Trump's election. The dollar may stay stronger for longer as well, which is not particularly helpful as a market economic thing. But we're beginning to see sentiment switch in the futures market, where we're getting effectively higher highs in terms of positioning as longs roll over to as shorts roll over to longs, and higher highs in terms of where those longs roll over to shorts at the top end. So everything's kind of coming together to suggest that the gold price is high. That is helpful, but other factors are beginning to support platinum as well in terms of potentially seeing a higher price than where we sit today.
That's great. I mean, I think what you highlighted one thing there. Sentiment matters, and I can definitely see that platinum positioning has improved, but palladium positioning still remains quite net short. Do you think there is potential for palladium pessimism to drag platinum lower as well, or do these things, do the two operate very separately?
I mean, there's always a link, but I think they do operate separately to a degree. I mean, the fact that palladium went to well over $3,000 an ounce and platinum kind of continued to hover around $1,000 an ounce tells you that the markets don't operate completely in lockstep. But I think the palladium is really interesting to me at the moment because, as you say, there's been this overall palladium negativity, and the rationale behind that is more than 80% of palladium goes into catalytic converters. And for investors, there was this view we were all going to be driving Teslas by 2030. So therefore, death of the internal combustion engine, palladium demand is going to disappear. And clearly what we're seeing is, as already discussed, that's not the case. And so the kind of value kind of construct for palladium is changing very, very quickly. And that kind of original view of everyone driving Teslas was very much embedded in the palladium futures market, where, as you said, Nitesh, we had this incredible short positioning. But over the last couple of months, we've seen that unwind quite sharply. So the first thing was Sibanye-Stillwater announced that they were going to be modifying their production plans and reducing them at their Stillwater mine in Montana. That's a palladium dominant mine. It does produce platinum as well. But then you had probably as a result of, at one point, Montana looked like it might be a bit of a swing state. So it became quite important from an election perspective. It ended up going quite strongly Republican. But the US, as part of that election process, asked the G7 to sanction Russian origin palladium and titanium as well. But palladium was obviously the focus of this conversation. But I don't think that was practically deliverable. But the mine sort of supply adjustment and then the US announcement just caused a real ruction in the palladium market. And we saw these really dramatic short covering rallies, drove the price up. But a lot of those shorts have unwound. And we got back almost to parity. We have seen some of those shorts being put back on again. But I think palladium is a market where, if you look at the supply-demand outlook, our forecast for demand is actually broadly flat going forward. So the automotive demand has been the bigger driver. We on our base case forecast see palladium eventually being substituted for platinum in the automotive industry. That liberates platinum for the hydrogen economy. But palladium, the consensus view, it goes into a surplus. That surplus is not a product of demand decline. It's actually a product of increasing supply from recycling. And recycling is really constrained at the moment. There's a shortage of end-of-life vehicles. If that persists, then that recovery curve for palladium in terms of supply growth from recycling gets pushed out, and it keeps palladium in a deficit for the foreseeable future, which really changes, the market perception of where value is today. And so palladium, I think, is likely to be a very volatile commodity. There's the potential for these short, sharp price spikes, the outlook could be quite interesting as a result.
Wow. Now, just going back to your outlook and looking at the various segments of growth or retraction, I see industrial demand for 2025 is pulling back. Tell us a little bit more about your thoughts there. Is that a view of a decelerating economy, or is there specific idiosyncratic moves in palladium in the industrial segment?
So you're right, it's a 9% year-on-year decline in terms of industrial demand for platinum next year. I would probably say that we kind of divide our demand landscape into four little buckets, really. So you've got automotive, jewellery, investment, and then everything else gets shoved into industrial, which is including things like medical applications and stationary hydrogen, all sorts of things. So it's a bit of a catch-all for everything. But typically for industrial demand, it's grown on average by about a 3.5% CAGR since 2014. However, most industrial demand is not really consumption. It's platinum that's used as a catalyst in petrochemical facilities or as a refractory lining in glass manufacturing, things like that. So it's when you build new facilities and populate them with that platinum, that's what kind of drives the big demand pull on a year-over-year basis. So the timing of those facilities is really important. You can get years where you get fewer facilities being built and years where you get more. So you can see that if you break down industrial demand into the individual components, chemicals will be up massively one year, glass the next, and vice versa. And so the overall picture can be quite volatile on a subsector basis, but as a whole, it tends to average out at being about a 3.5% consistent CAGR. The thing for next year is actually just we've got so much fewer glass manufacturing facilities being constructed that it's enough to just drag down the year as a whole. This year, we've got a lot of glass facilities being constructed. So it's just the timing of the infrastructure cycle and when new facilities are being brought online.
Edward, so before we let you go, maybe we give you a final challenge, which would be to bring it all together and summarize your big picture view and in terms of how all of those variables come together and what you see for platinum in 2025.
So, look, thank you for the opportunity. I think it's really just these sustained themes, really. Supply is constrained. There's very little incentive to increase supply. There's a lot of risks to the outlook in terms of recycling supply, and that kind of base case assumption that we see an increase going forwards. And then in terms of demand, it's just looking pretty robust overall. And I'd certainly say there's a reasonably good upside risk to automotive supply from this ongoing consumer trend of slower adoption of battery electric vehicles and then therefore higher for longer internal combustion engine demand, probably mostly hybrid vehicles, in order to kind of try and hit those fleet-wide CO2 reduction targets. So yeah, it's a pretty healthy picture for platinum. We're not talking about staggering demand growth. We're talking about a picture where there's sustained inadequacy of supply to satisfy demand. That's resulting in a dramatic depletion of above ground stocks. And at some point, we'd expect that to begin to reflect itself in terms of the market establishing value for platinum and therefore platinum pricing.
Excellent. Well, we look forward to seeing how that story unfolds. Thank you very much, Edward Sterck, for joining us once again. And hopefully, we look forward to having you back on the show at some point in the future.
Thank you very much, Ed.
So, Nitesh, we spoke a lot about platinum, but some bonus material for our audience. I think we would be doing them a disservice if we didn't speak about some of the commodities elsewhere that have been doing a lot and a lot for us to track, and those are particularly in the energy sector. Nitesh, I know oil and gas have been in the news lately, so maybe we touch a little bit on those and get your take. Starting with oil, we know we've had the news of ceasefire in Lebanon. We've had the news of postponement of the OPEC Plus meeting. So a lot to uh, a lot to grapple with in terms of what's going on in oil markets. How do you see it?
Yeah, I think there's plenty of news flow to keep us interested here. So, you know, oil has had that push pull. There has been escalation in geopolitical risks. We saw that with Russia, firing medium range missiles that are potentially capable of carrying nuclear warheads. When we saw that, that put the markets on jitters, and oil responded, rose as that geopolitical premium got priced into oil. And then with the prospect of a ceasefire between Israel and Hezbollah, we saw that come off again. So it's getting pushed and pulled by these factors. Um, I think that geopolitical risks are going to just be hard to solve. We know the incoming Trump administration wants to solve a lot of the wars around the world, but I think it's easier to make that claim than it is to actually deliver. Um, there is a lot of talk in the markets about some of the issues are being escalated just to be de-escalated later on. Provides that bit of a bargaining chip to for negotiations later on. But I think given the complexities out there, particularly Ukraine wants to win the war on its own terms. We know that there are deep scars being uh, traced in the Middle East as a result of this war, and I don't think they'll be resolved that quickly. Which means I think that geopolitical premium will remain in oil. But on the flip side, demand for oil has been relatively weak because China's demand has been faltering. Um, but if China feels the pressure of all the trade protectionism that is likely to come its way, once again catalyzed by the change in administration in the US and just the ongoing pressure from Europe, it may use some of its fiscal firepower that's been holding aside. And if it does that, that will boost its energy needs, and therefore could be a driver for oil demand higher. So, and there's quite a few things to look out for in oil markets. But one of the key things, as you mentioned earlier, is OPEC and the fact that it's supposed to make a policy decision. That was supposed to happen this Sunday, and we're recording on Friday the 29th, and they were supposed to meet up on the um, over the weekend to decide on its next production target. They've postponed that to later on in the week, and I think the 5th of December. The reason they put formally is because there's a Gulf Governing Council meeting on over the weekend, but usually when they postpone meetings, it's usually so that they can make a pre-deal beforehand, before the actual meeting. So, and last week there was lots of rumors about um, the increase in production of 118,000 barrels that was supposed to start in January, to postpone that. So OPEC are holding back significant amounts of production off the market right now to tighten the market. The plan was to loosen the market incrementally, but they keep pushing that out. So there could be a deal to push out that increase in production a little bit further, keep the markets tight. But the key question is what happens after that? If we get a change in administration in the US, which is a lot more friendlier to oil production, will OPEC continue to keep the markets tight from its side and allow market share to be gained from other players like the US? Um, that's yet to be seen. I think OPEC is sort of in that wait and see mode because at these prices, I don't think there's a massive incentive for US oil producers to expand oil production. So even if there is deregulation in the US, the financial incentive doesn't exist at the moment. But that's yet to be seen. If we do get any increase in the price, we may see the politics of OPEC adjust a little.
So, Nitesh, as we record this sitting in the UK, I see some sunlight coming through the window, but I also know that this morning, when I looked out of the window, everything was frozen, and we're in that part of the year where you wake up in the morning and you just see ice outside. But what that means is colder temperatures, more demand for heating, and as a result, sometimes we see prices for natural gas going up, which we have seen lately. How do you see what's going on in natural gas, and what can we expect going forward?
Yeah, natural gas is extremely interesting, partly because it's a fragmented market from a global standpoint. The US is its own market, Europe is its own market, Asia is its own market, and there's quite big price differentials between all of those regions. Um, but if you look at the US, we did see a substantial increase in natural gas prices over the last few weeks after um, prices had reached rock bottom. So if you look at spot Henry Hub prices um, in early November, they actually reached the lowest level since the data exists, and we've got the data since the 1990s. So um, from a very low base, it increased substantially. But um, you know, once again, I stress it is from that low base, so we're still fairly low prices in general for natural gas price in the US. The US produces lots of natural gas, and so much so that it has to flare some of its excess production. Its storage is somewhat limited, but luckily it's built out an infrastructure to export some of that natural gas around the world um, through liquefied natural gas. And over here in Europe, there is a nice big captive customer, and in Asia as well. Both of these regions are net short on natural gas and are willing buyers of US natural gas. In Europe, a just keep putting a bit of context in Europe's situation. The Russia-Ukraine war, really disrupted the markets and given that most of the natural gas supply in Western Europe came from Russia through pipeline supply. Now that has been displaced by imports of liquefied natural gas and pipeline imports from Norway and a few other regions. Now, with the cold snap that you referred to, that extreme chilly weather that we've been experiencing the last few days, that has driven up natural gas demand in Europe and created a nice spike for the title transfer facility benchmark here in Europe. And because we're so LNG dependent, which has to be stored, that storage runs risk of falling. Now, if we don't get any new supply of natural gas from LNG or pipelines that are shut down from Norway, for example, we've only got about 29 days worth of supply in storage, right? So it's not much. So even small disruptions or small spikes in demand can send prices spiking higher by some large margins. Now we've got some challenges up ahead. One, I said most of the pipeline supply from Russia has vanished, but there is still some pipeline supply into Western Europe, but that goes through pipelines through Ukraine, and the contract for those pipelines, well, the vast majority of those contracts come to expiry at the end of this year. So we could get another shock in terms of supply coming off the market. Gazprom has already reduced some of its supply after one of its, one Belgian utility is forcing Gazprom to settle a court settlement and by not paying Gazprom. So Gazprom have already shut some of their taps off there. So there was a lot of risk in European supplies coming offline and sending prices considerably higher. And once again, I stress that if you're exposed to European inflation risks, you're probably best off having some hedging exposure to European natural gas prices. And then the third region, Asia, we are seeing increasing demand for natural gas in Asia, even though oil demand remains relatively weak in places like China. Elsewhere in the region, we are seeing natural gas demand remain strong, and that acts as a competing region for the supplies that are coming from the US or Australia or Qatar or any of the large natural gas producers. So I have quite a constructive view on European natural gas at this point.
Excellent. Well, thank you, Nitesh, and thanks everyone for tuning in. We hope you've enjoyed this episode of the Commodity Exchange. If you want to hear more from us, please subscribe on whichever platform you're using, and please take a moment to leave us a 5-star rating. You can follow us on LinkedIn or X, and make sure to follow Wisdom Tree in Europe on those platforms as well. And if you want to learn more about commodities, visit Wisdom Tree's website, where we have a wide range of research materials and insights, including our most recently published Commodity Monthly Monitor. Until then, and see you next time.